Hey, I'm Paul Rabalais, and it's that time of year again because in this video I'm going to talk about the first of three parts of the 2020 estate and gift tax rules with some analysis. So because I got a lot to say and people got a lot to learn, I'm going to break this 2020 estate and gift tax analysis into three parts. This first part is going to be about the present interest annual exclusion. Let's jump right in. So most people know about it as the $15,000 rule. A long time ago, for many years, it was the $10,000 rule. Most people don't really keep track of it that close. But the present interest annual exclusion, more on those words in a minute, for 2019 was $15,000, and for 2020, it will be $15,000. Sometimes it goes up, sometimes it doesn't. It's adjusted for inflation, but it only goes up in $1,000 increments, so it doesn't go up every year. So $15,000 will be the present interest annual exclusion amount for 2020. So what does all that mean? Well, what it means is you can give away, if you want to get it out of your estate, $15,000 to as many people as you want to every year, and you don't have to report it on any gift tax return. And no gift, regardless of the value, is ever reported on an income tax return. Gifts, regardless of their value, they're not reported on the income tax return for the people who receive the gift, and it's not reported as any kind of deduction on the person who made the gift. It's really all about our completely separate estate and gift tax kind of unified system that we have. So when someone does make a gift larger than the present interest annual exclusion of $15,000, still no gift tax is paid. That donor, the person who made the gift, simply has to report it on a gift tax return, IRS Form 709, and they have to show that they started to use some of their estate tax exemption, which for 2019 is $11.4 million. More on the next part 2 of my three-part series on the estate tax exemption. So a little bit of confusion out there amongst the public about this $15,000 and what does taxable and not taxable mean, but that's the gist of it. Now, in addition, a lot of people don't know that if you are in this gifting mode, in addition to making a gift of $15,000, in addition to that, you can also pay the educational and medical expenses of the person that you're making the gift to. And there's some rules on that. If you're paying for their education, that tuition payment must be payable directly to the educational institution. If you're paying for their medical expenses, it must be payable directly to the healthcare provider. So that is in addition to the $15,000 that, so you could write them a check for $15,000 and then go pay their tuition and their medical expenses as well to get more out of your estate to avoid the 40% estate tax when you pass away. All right, so when you make a gift of the present interest annual exclusion, you can make either what I call an outright gift or a gift in trust. What's an outright gift? An outright gift is you write your child, you write your grandchild, you write your niece or nephew or anybody you want to, you write them a check for $15,000 and you give it to them and they deposit it in their account. That's an outright gift. Or maybe you just transfer some publicly traded stock that you have from your investment account into their investment account. That's an outright gift. They can have it. Many people, however, prefer to make gifts in trust for their children, their grandchildren, those donees. Now and this is where we get into the wording of present interest annual exclusion of $15,000. When you make a gift of $15,000 or any amount to someone in a trust, you're not giving them a present interest in the gift. You're giving them a future interest in the gift because the trust might say something like, I'm putting this in trust for you. It's there for your education. You can get it when you're 25 if there's anything left, but you're not going to be able to take it all right now and go spend it. That is a gift of a future interest. And so when you make a gift of a future interest, that doesn't qualify for the $15,000 present interest annual exclusion. But you can meet the present interest requirement by giving them these crummy withdrawal rights. Crummy, C-R-U-M-M-E-Y, it's based after a court case, where you give them a period of time, let's say 30 days after you make the gift in trust, within which during that time they can take the gift, and if they don't take it, it just stays in trust and then they benefit from it later. And typically they never choose to take the gift because they realize that if they take the gift and don't allow it to remain in trust, they'll never get another gift from you ever. So it's just some procedural formality stuff that has to be fulfilled when you want to make a gift in trust but have it qualify for this $15,000 present interest annual exclusion. If you don't follow the rules, then by making that $15,000 gift in trust, you'll be using some of your estate tax exemption, which you didn't need to use by following the rules that we talked about. In addition, kind of a few other areas having to do with this $15,000 present interest annual exclusion. A lot of parents, a lot of grandparents setting up 529 plans for their children, for their grandchildren. You can bunch 5 years worth of annual exclusion gifts in 1 year. When you put it in a 529 plan, you've got to report that on your IRS Form 709. In addition, you can make unlimited gifts to your spouse. And on the point of being married and making gifts, sometimes married people engage in some gift splitting. That's when one spouse makes perhaps a $30,000 gift to their child, but by reporting it properly by both spouses and making the gift splitting elections on the gift tax return, then that $30,000 gift made by one spouse is deemed to be split and made $15,000 by each spouse, again, not triggering any type of using up some of the estate tax exemptions. Okay, so there's your high points on the 2020 $15,000 present interest annual exclusion. It's not changing from 2019. In addition, and then the other points are, in addition to the $15,000, as long as you follow the rules, you can pay the educational and medical expenses. In addition, you can make a gift outright or in trust. But if you make it in trust, make sure you do what you need to do to qualify for the present interest annual exclusion. You can bunch 5 years of gifts together in 1 year in a 529 plan. Spouses can make unlimited gifts to each other, and spouses can engage in gift splitting. So my next video that I'm going to do tomorrow is part 2 of the 2020 estate and gift tax rules. It's all going to be about the new estate tax exemption amount and how to properly take advantage of that to protect what you have, keep it in the family, avoid paying any unnecessary estate tax. All right, so hope that helps. Feel free to comment below. Real important that you subscribe. Apparently, according to YouTube, the more that people subscribe, punch the like button, and then comment below, the more people YouTube will make this video available to. So that's real important as we try to spread the word and educate as many people as we can about protecting what you have, keeping it in the family, keeping it away from the government, and making all this process simple for you and your loved ones. Okay, so I'm Paul Rabalais. Look forward to tomorrow's video. Y'all have a great day.